Wall Street prepares for a potential government shutdown. Joining us today is Rob Conzo of the Wealth Alliance. Rob, what's your best investing advice for times like these?
It's an interesting time because people get very nervous about shutdowns and there's a lot of headline risks that typically follow. So just for a little context, a little background, the last 50 years have been 21 shutdowns. The two biggest ones that happened, the last one was during the Trump era, was 35 days from December of 18 to January of 19. The market dropped and it started a week before the actual shutdown. So there was a lot of anticipation, dropped around 15%, then quickly came back and rose past that. Before that was 1996 with the Clinton era. It was 21 days. So we know a couple of things about shutdowns. Typically, there's headline risk, markets drop, but then they typically come back. And when you have a situation like that, we tell people there's a couple of things you really can do. And that's a couple, you could buy stocks on the dip. And number two, you can take tax losses. Now, trying to predict areas, we all know gold's at a new high. Some people are flocking towards money markets. We're more in the camp of let's take some discounts. Let's take some buys of stocks. Let's get some tax losses. So that's what we're advocating people to do. Not to try to predict, is this going to be a 2 week, a 1 week, a 35 day? I think that's just too hard. And the way to go is also too hard to go off of.
There are some analysts that saying this could be worse, particularly given the fact that Trump is threatening to fire a large amount of federal workers. What do you think? Do you think that we could see more volatility as a result?
Well, Trump has basically, like he always does, raised the stakes in a real big game of chicken. And he threw this last one out, which is mass firings. But typically, we've never seen in shutdowns firing people. Furlough, yes, and that could happen. As far as more market jitters as a result, this is really Trump calling out the Democrats and saying, look, I'm willing to go to the mat on this one. I think it's more of a negotiating tactic. We don't believe there'll be mass firings. And as far as how long the government shutdown will be, he's already proven he's not afraid to shut down the government. He did it. At the end of 18 into 19, for the longest time period, it was 35 days. Before that was Clinton, 21 days. So he's willing to do it. As far as firings, no, we don't see it. And I think more market volatility due to firings. I think it provides just a lot of good talk, but not more market volatility as a result.
Well, should the government shut, we won't get some key economic data like Friday's jobs report. Do you see that as potentially clouding the Fed's view as it tries to shape its monetary policy?
Well, it doesn't help, that's for sure. But I will say, if you look at the data that generally we've gotten to this point, PCE going from 2.6 to 2.7, very low for the year. It's basically flat. Unemployment at 4.3. Retail sales doubling estimates. On the earnings front, you're looking at 11.7 on the S&P for the second quarter, to the third quarter in a row, double-digit growth. 81% of S&P 500 companies beating their earnings estimates. This is good news. Maybe if we do have a pause in some data, maybe not the worst thing in the world. We are in an area of hypersensitivity as far as transparency is concerned. I don't see it being that bad to push this off a bit if it does happen. And if it doesn't, then we're still back on track to where we are.
Well, the Fed has been concerned about a weakening labor market, and we did get economic data today about the jobs market. We got the JOLTS report for August that showed more jobs were added than expected, but hiring also decreased. Talk us through the data that we saw today.
Yeah, the JOLTS report just came out, which is a job openings and labor turnover survey. But when you really look through the numbers, going from 97 to 94, which was last month 97, this month 94, small drop around 3. The Michigan survey did back that up as well. It did drop a little, 58 to 55. But my numbers are funny. Look at the American Association of Individual Investors, AAII survey. That went from 28 to all the way up to 42. That's a big increase. So pick your poison. I think there's worse sentiment. Yes. Why? Tariff concerns. Potential government shutdowns, uh, labor not hiring as much. So people are worried. And let's not forget, we're in the third year of a bull market. When that happens, the anxiety goes up, people get nervous, and you do see some negative sentiment on what's on the horizon. So I'm not surprised that it dipped a little, but it's not an area I'm hanging my hat on. The real data that just came out and has been coming out, PCE, retail sales, earnings, unemployment. These are very, very strong numbers, and most economists believe the economy is in a pretty good spot. And let's not forget, the yield curve is now not inverted anymore. The spread on that is like 57 basis points. That's big. That's also not pushing towards a recession at all. So I'm feeling pretty good about the economy.